Now speaking, Mickey Foster, Vice President, Investor Relations. FedEx Corporation held its fourth quarter earnings conference call, which was streamed and available for replay on the company's website for up to 1 year. Joining the call were members of the media and CEO Raj Subramaniam, Executive Vice President and CFO Mike Lenz, and Executive Vice President and Chief Customer Officer Brie Carrere. The company took advantage of the safe harbor provisions of the Private Securities Litigation Reform Act, meaning certain statements made on the call may be considered forward-looking statements. Investors can refer to the investor relations portion of FedEx's website for a reconciliation of non-GAAP financial measurements discussed to their most directly comparable GAAP measures. Now speaking, Raj Subramaniam, President and Chief Executive Officer. FedEx has made significant progress in its transformation to become the world's most flexible, efficient and intelligent network. The fourth quarter saw revenue decline 10% year-over-year due to soft demand across the market, but rate of volume decline improved sequentially. Yield trends have been pressured in international markets, however FedEx is committed to maintaining a disciplined pricing approach focused on the long term. Despite the challenging environment, FedEx achieved an adjusted operating margin of 6% and adjusted earnings per share of $14.96. Cost-out efforts are taking hold and operational improvements are being driven by picture proof of delivery, 4-hour estimated delivery time window, dock modernization, and machine learning to develop more detailed and accurate volume forecasts. Ground remained a standout with a 12.1% operating margin. Express has aligned costs with underlying demand through structural and volume-related initiatives, including retirement of aircraft and domestic efficiency initiatives. At Freight, the team is focusing on maintaining pricing discipline while flexing costs to protect profitability. Overall, the company achieved a $2 billion year-over-year reduction in operating costs in Q4 FY23. Additionally, the consolidation of operating companies into one unified organization will create significant efficiencies, resulting in $1.8 billion in cost reduction benefits in FY24 and $4 billion of permanent cost reductions in FY25. Canada marks the first large-scale implementation of Network 2.0, expected to generate an annualized benefit of over $100 million upon completion in FY25. Looking ahead to FY24, FedEx expects revenue growth to be pressured due to the dynamic external environment. It will take a prudent approach to outlook and focus on reducing capital intensity while looking for additional opportunities to modernize its aircraft strategy. Now speaking, Brie Carrere, Executive Vice President, Chief Customer Officer. FedEx experienced a challenging fourth quarter operating environment with year-over-year volume declines and moderated yields across all transportation segments. Revenue at FedEx Ground was down 2% due to a 6% decline in volume, partially offset by a 5% increase in yield from surcharges and product mix. FedEx Express saw a 13% revenue decline driven by parcel volume declines and a 25% drop in freight pounds due to a customer strategy change. Revenue at FedEx Freight decreased 18%, primarily due to a market slowdown and high inventory levels. Yield was pressured year-over-year, but pricing discipline remained strong. To improve service and create meaningful differentiation, FedEx is rolling out picture proof of delivery, narrowing 4-hour delivery windows, introducing returns programs, and launching sustainability insights. The latter provides customers with estimated carbon emissions for tracking numbers and accounts, enabling them to transfer the data to their own systems via an API. Now speaking, Mike Lenz, Executive Vice President, Chief Financial Officer. FedEx closed out fiscal 2023 with strong operational execution, highlighted by ground operating income increasing 18% and operating margin expanding 210 basis points to 12.1%. Express saw sequential operating margin improvement as the team drove structural and volume-related cost improvements, while Freight navigated a softening volume environment. Non-cash items included an impairment charge of $70 million related to aircraft retirement and $47 million of goodwill and other asset impairment charges related to the Shop Runner acquisition. Looking forward to FY24, FedEx anticipates flattish revenue for the full year and adjusted earnings per share toward the low end of the range of $16.50, $18.50 in a consistent demand environment. Should macroeconomic conditions support improving demand, full-year adjusted earnings per share could be closer to the high end of the range. FedEx will continue to reduce capital intensity and repurchase an additional $2 billion of stock in fiscal 2024, while also increasing their dividend by 10%. Wells Fargo Securities analyst Allison Poliniak inquired, "Could you explain how the unique features of the Canadian region affect optimization deployment, and how it differs from the U.S.?" Raj Subramaniam replied, "Allison, thank you for your question. In Canada, we're taking a different approach than what we do in the U.S. The population is concentrated in certain geographies and the volume is split 50-50 between Express and Ground. We decided to consolidate everything under Express, beginning April 2024 and completing September 2024. Doing so reduces our cost by $100 million and improves service differentiation. It's a unique move to Canada, since our U.S. approach is a hybrid of couriers and package handlers. Thank you again for your question. Goldman Sachs analyst Jordan Alliger inquired, what proportion of EBIT can we expect in the first half and second half of this fiscal year? Mike Lenz replied, Jordan, demand projections for the second half of the year will be relative to what we're currently experiencing. The significant inflection we saw last year was late in the first quarter, with that most pronounced at Express. We'll be lapping that for the first quarter, and freight volume accelerated into the mid to upper teens later in 2020. We're not expecting any material inflection in the demand environment. Evercore IC analyst John Chappell inquired, Mike, could you break down how much of the $300 million in revenue net of cost increases is due to volume versus price? What portion of the $2.7 billion variable costs taken out this year will be added back in fiscal 24? Mike Lenz replied, the underlying expectation for inflation is moderated growth. We anticipate that demand will be muted, but our drive savings and other positive contributions should offset any headwinds we may encounter. As we move through the year, volume declines should diminish, though the rate of yield increases experienced in 2020 won't be repeated. J.P. Morgan Chase & Company analyst Brian Asenbeck inquired, Bree, can you discuss any evidence of decreased demand or customers trading down due to the uncertain environment? Additionally, have there been any customers changing their air freight practices, and have those changes impacted ground or express deliveries? Bree Carrere replied, the short answer to the question whether we have seen any benefit from the UPS labor negotiation in Q4 is no. We haven't planned for any benefit moving into fiscal year 24 either. However, this has opened lots of doors, and we're having many great conversations with legacy UPS customers, which has resulted in a strong sales pipeline. As far as mix is concerned, most of the changes are apparent in our Asia-Pacific region. We reopened our ID product, which has been performing well, so I'm pleased with the sales pipeline from that team. Stevens Incorporated analyst Jack Atkins inquired, what measures is the company prepared to take should customer demand deteriorate, and will the $800 million of international export yield pressure return the company to pre-COVID levels? Mike Lenz replied, Jack, the revenue outlook for this quarter is flattish year over year. We're aware of this and have taken measures to adjust our network accordingly. For example, at Ground we've seen significant volume declines but improved margins and profitability over the last few quarters. Express has also been able to mitigate the reduced demand. We will act swiftly should our expectations not be met. Raj Subramanyam replied, at the lower end of the range, 1%, we are seeing revenue growth, while at 2% and 3%, it is more significant. We have drive working and other levers we can pull for even greater operations leverage. Bree Carrere replied, yes, we have planned for the $800 million impact this year. We expect to recover from it as the year progresses. Citi analyst Chris Wetherbee inquired, what is the timing of the $1.8 billion in cost savings for fiscal 24? How much should be expected in the first quarter and first half? Mike Lenz replied, sure, Chris. The $1.8 billion is built up sequentially over the year as we continue implementing our drive framework initiatives. We won't see the full effect of these in the first quarter, but they will add momentum and build up to $4 billion by FY25. Barclays analyst Brandon Ogolski inquired, Raj, could you explain how the hybrid model of transitioning markets to one FedEx operation is working in states that have overlapping contractors and employee drivers? Raj Subramanyam replied, we have experienced a lot of growth and transition this quarter. Our approach has been to leverage the right technology and facilities and prioritize our people-first PSP philosophy in each of the markets we are operating in, such as Alaska, Hawaii, and Minneapolis. We have implemented a hybrid model in which some markets will have couriers and others will use contractors. This decision is data-driven and made with the goal of providing quality service while keeping our people safe. We anticipate taking a bit of time to work through these decisions, but we are already making progress. UBS analyst Tom Wadewitz inquired, what are the key assumptions behind your fiscal 24 guidance and do you think it gives you room to overachieve? Raj Subramanyam replied, Tom, in our latest quarterly earnings report, we are pleased to report that for the first time in the history of FedEx Ground, volumes declined while operating margins expanded. This is a testament to the success of our drive initiative and the hard work of John's and Richard's teams. In terms of macroeconomic trends, when we previously discussed in September, industrial activity was slowing, inflation had caused interest rates to drop, and consumer spending shifted to services rather than goods. Additionally, there was an e-commerce reset due to the pandemic. All of these factors were detrimental to industry volume across the board. Looking ahead, the same trends remain in place, but we anticipate e-commerce growth moving forward. We will continue to monitor GDP, trade, and inventory-to-sales ratios carefully. Ultimately, we are focused on what we can control, and we are confident that our drive program will help us come out of this period stronger than we went in. Mike Lenz replied, Tom, this is Mike. The progress at Express has been significant despite some headwinds. We are expecting a total of $1.2 billion in non-recurring international and domestic freight headwinds in 24. Despite these, we are still projecting up margins at Express through the discipline and rigor of drive and a muted demand environment. Bank of America Merrill Lynch analyst Ken Hookster inquired, Mike, what's your expectation for the scale of improvement in Express? Could you reach mid-single digits? Is there a range within the target for ground, and if so, will it reach double digits? What about freight margin? And, do you have any thoughts on Europe and TNT integration within Express? Mike Lenz replied, for Express and ground, we anticipate margin improvement in 24. We will see some margin pressure at freight, but that is expected to mitigate as the year progresses. The Express margin should also improve beyond Q1. In Europe, we are projecting improved profitability as part of our Express initiatives, with $600 million of value realized this year and going forward. Wolfe Research analyst Scott Group inquired, Raj, what is the revenue to earnings sensitivity? How much of this year's $5.7 billion capex is for aircraft? Mike Lenz replied, Scott, the aircraft capex for 23 came in at $1.7 billion. We expect it to be slightly lower in 24 and 25 at $1.5 and below billion, respectively. As Raj mentioned, we anticipate it to continue to decrease in 26. Raj Subramanyam replied, Scott, the 1-2-3 formula is simple, but when it accelerates beyond that, we have significant operating leverage and the curve becomes nonlinear. You can think of it like a crocodile opening its jaws. The bigger the acceleration, the more impactful our operating leverage. Melius research analyst Connor Cunningham inquired, can you clarify your assumption regarding revenue for 2024, specifically as it applies to export yield pressure and volume? Brie Carrere replied, at the midpoint, we expect to see 2% revenue growth. In the U.S., Express and ground parcel volume should reach flat levels by early Q2 and increase from there. FedEx freight may lag behind due to lagging impacts. Our international business is expected to recover throughout the year due to yield impacts. Vertical Research Partners analyst Jeff Kaufman inquired, Brie, what signs of optimism are you seeing in your network? Where have we seen increases in activity, and where have we noticed declines? Brie Carrere replied, it's a fair question. We're expecting flat to low single revenue growth given the current economic climate. We don't play in grocery, so our share of e-commerce growth is around 2 to 3%. We'll be looking for potential shifts in consumer strength and reopening of Asia as we head into peak season. Lastly, we're seeing some positive signs in Europe with domestic markets and are working hard from an operations and sales perspective. Cohen and Company analyst Helen A. Becker inquired, Operator, can you please provide an update on the cost increase associated with the pilot's new contract and whether any pilot retirements are planned? Mike Lenz replied, Helen A., the tentative agreement includes a payment upon implementation and the FY 24 scale increases. We have incorporated both of those items into our pension figures. In addition, we are expecting to park 29 aircraft during the year, with 9 being permanently retired. Oppenheimer and Company analyst Scott Schneeberger inquired, what progress have you made in the last year in terms of taking out flights Trans-Pacific, Transatlantic, Asia, and Europe, and what can we expect going forward? Mike Lenz replied, Scott, flight hours were down 12% in the fourth quarter compared to volume decline. We've made significant reductions in our network capacity, as anticipated with easing of the supply/demand constraints. We'll continue to reduce Trans-Pacific and Transatlantic flying to match demand, and use market flexibility for capacity optimization. AllianceBernstein analyst David Vernon inquired, Mike, are margins expected to improve in 2023? Brie, with the change in customer behavior, is priority mail revenue declining and how does that affect our plans to reduce the fly network? Mike Lenz replied, David, our projected margins are expected to improve due to the initiatives we have outlined. Brie Carrere replied, our long-standing and profitable relationship with the United States Postal Service has enabled us to account for their 10-year strategic plan, which is to track more volume and fly less. We are committed to meeting the service obligations in the contract, which ends in September 2024. That being said, we have accounted for the headwind this year and will be ready to adjust our network accordingly when the time comes. In terms of purchase transportation costs, they're down 40% year over year, the lowest percentage of revenue in 10 years, due to softer macroeconomic conditions. As the macro improves and more costs come out of our network, we may need to source third-party capacity to meet our volume rebound needs. Mike Lenz replied, Joe, as I mentioned, we saw margin expansion and cost control at ground due to lower line haul expense. We optimized our networks and moved high-cost, ad hoc external line haul spend into our scheduled network, resulting in lower rates for planned line haul purchase transportation. This optimization contributes to a holistically improved pickup, delivery, sort, and facility operations network. Stifel Financial Corporation analyst J. Bruce Chan inquired, what would be the impact on facility closures and furloughs if a major competitor exits or if the LTL market is stronger than expected? Mike Lenz replied, sure. In response to Bruce's question, we reacted quickly to the declining volume earlier this year and we're still able to expand margins. We're looking to optimize our facilities by consolidating the 29 smaller ones into larger, more efficient ones so that when demand recovers, it can be more easily accommodated with greater incremental contribution. Deutsche Bank analyst Amit Mehrotra inquired, Mike, what do we expect for Express and Ground profits in the next quarter? Raj, what are you looking for in the external CFO search? Mike Lenz replied, freight margins will be down for the year, but Express will see the smallest change in Q1 relative to the rest of the year due to a late surge in demand last year. Raj Subramanyam replied, we appreciate Mike's incredible work over the last 18 years, and his contributions to our finance team and organization. As we look toward succession planning, we are searching for a candidate with both a deep financial background and strong operational experience to help lead FedEx through our Drive transformation program. Mike Lenz replied, thank you, Raj. It has been an incredible 18 years at FedEx, a privilege to serve as CFO for the last 3 years and a true challenge in 2020. The FedEx team was resilient in the face of obstacles, so much so that we are now well positioned for the future. On behalf of the entire FedEx team, I want to thank Fred and Raj for their leadership, and my family for their unwavering support. I'm grateful to have shared our exciting plans and bright future with everyone here today. As I embark on this new journey, I have peace of mind knowing that FedEx is in a strong position. Raj Subramanyam replied, thank you, Mike. I'm pleased to report that our team has made great strides towards building the world's smartest logistics network in fiscal year 23. We are confident that we will continue to make progress and seize the opportunities ahead of us as we enter fiscal year 24. Thank you for your attention, our team appreciates it.